And we actually had a pretty good day on Friday. MBS were up 30 basis points early. The 10-year was down 8. Nice rally overnight. The most notable scapegoats arrived in the overnight hours with several weaker PMIs in Europe, as well as a much lower PPI across the entire Eurozone. After a brief pullback heading into domestic hours, U.S. trading is adding some gains with 10-year yields down 8 basis points in the morning. This morning's improvement is mainly due to stocks rallying on signs of underlying strength in the world economy. It is likely to be short-lived, though. The reprice risk on the day was high, especially for lenders who are quick to pass along gains and quick to take it back because it is a Friday after all, and they want to cover themselves for the weekend and head out early. ISM non-manufacturing came in as a headline of 55.1 versus 54.5. Forecast was 55.2 previously. Prices came in at 65.6. It was 67.8 previously. Jobs were 54 and when it was 50 previously. So the jobs are still holding strong in that services section. Anything over 55 in today's ISM was likely to cause a bit of a selling, and here we are with a bit of selling as of the time that happened. The supplier deliveries index hit the fastest level since 2009, indicating that supply chain issues are mainly in the rearview mirror. The prices index declined, however, it is still elevated. That said, since we're not able to reduce cost to maintain margins, we have to reduce employee base more aggressively to achieve margins. Quarter 4 GDP came in at 2.7%, down from 3.2% in the third quarter, primarily due to softening consumer spending, suggesting weakening. However, in January, the Fed's favorite inflation measure rose meaningfully, with December's reading being revised upwards. Consumer spending jumped 1.8% month over month, the largest rise in 2 years, probably aided by the mandated minimum wage increases, annual pay raises, Social Security inflation adjustments of 9%. All that said, let the hikes continue. We also had Fed Governor Christopher Waller sounding hawkish with remarks from yesterday. I would be very pleased if the data we receive in inflation and the labor market this month shows signs of moderation, but wishful thinking is not a substitute for hard evidence. Non-farm productivity rose 1.7% in the fourth quarter, according to BLS. This is a big downward revision from its initial 3% estimate. Unit labor costs rose 3.2%, which was driven by a 4.9% increase in compensation. The job market and wage growth keeps going, so people can buy more stuff, keeping our inflation high. Today's trading action flew in the face of the prevailing reaction function for the bond market. Specifically, an important economic report was stronger than expected, but bonds rallied nonetheless. At the end of the day, we're up 39 basis points at 99.59, which puts us right above that third red level. So we actually bounced through two levels of support, ending at the day just above that red line, which is the R2 retracement at 99.547 with a ceiling of 99.845. So we have tight ranges here. Let's see if it holds when Monday rolls around. We also got news that venture capital firms raised a grand total of $20.6 billion in the fourth quarter, a 65% decline from a year ago, the lowest fourth quarter amount since 2013, and returns fundraising levels to levels last seen in 2015. It was also less than half the amount raised in the third quarter, and the first time fundraising levels declined from the third to fourth quarter since 2009. Investors put money into 266 venture capital funds compared to 620 the year before. That's from econ70.com. So I hope everybody had a great week and get some time to chill out over the weekend. If you have some extra time, try to learn something by going to our common sources, which are our sponsor at WellThatMakesSense.com, which has a great series going on right now about the invisible selling machine and how to generate customers off of the internet.